All right, we have a quick inflation update for you. The Fed's favorite gauge, the PCE, right on target for August. Prices rose 0.3% for the month, 2.7% year over year, and core inflation stayed steady, 2.9%. So inflation is not running hot. It's not crashing. It's steady. And yesterday's GDP report showed the U.S. economy grew 3.8% in Q2. That is the fastest pace in nearly 2 years. So the economy is growing, inflation is steady, and it looks like the Fed has room to maneuver. Jeffrey Small, partner of Retirement Income Sources, joins me now. Jeffrey, good to have you back. So for American families, what's the real impact of these numbers on their wallets?
Well, $100 12 months ago for things that we like to buy at the grocery store or things for our houses now costs $102.70. And so, we're just 70 cents above from an inflationary standpoint the last 12 months where the Fed is clamoring we have to be before they take more action and try and reduce rates, even though they're forecasting 2 additional rates this year. The economy is strong. Wages are increasing at 4 to 5% a year right now with inflation moderating. And so what the Fed really wants to see, Alicia, is they don't want to see a 0.3% increase in the CP in this PCE. They want to see a 0.2 instead of a 0.3. And so we're right there. We're just on the cusp.
Okay, so how do what consumers expect for inflation moving forward and what the markets expect differ? And why does that matter for the Fed?
Well, I think the consumers just really want cheaper prices. I think the Fed is overly managing the economic data on where we are in terms of the increases. I think the Fed they've hung their hat on the fact that they're not going to do anything until they can see the inflationary environment drop to 2%. And unfortunately, I think if they dropped rates 50 basis points tomorrow or 50 basis points in October, I don't think it would make a difference to the inflationary patterns because we have an economy that is very strong and vibrant in the tech side. And in the rest of the other side of the economy, we have an economy that's not very vibrant and strong and is showing extreme signs of fatigue and inactivity and in a state of decline. And so the Fed is trying to balance that out right now.
Yeah, the numbers do look steady, but are there any hidden risks that we should be keeping an eye on?
Well, we should be keeping an eye on the fact that inflation is the ultimate risk here. And I think it's been quelled that tariffs do not cause inflation. It's really kind of a one-time event. And so, hats off to President Trump there. He was correct and all the pundits were incorrect on his tariffs impacting inflation. And so if we did have rapidly rising inflation, though, that would cause the Fed to halt their rate declines here and put them on pause. And that would not be good for the economy, the consumer, or the markets.
All right, Jeffrey Small with Arbor Financial. Thank you for your time today. As always, have a great weekend.
Thank you.